use cases of Web3 through DePIN.
Everyone loves evolution. A simple sound. A transformation. A glowing light. As Darwin said, it is not the strongest of the species that survives, nor the most intelligent, but the one most responsive to change. So be part of the change.
Hello everyone, Daniel from DePIN Hub here. Today we're interviewing Conor, co-founder of USD.AI, a groundbreaking protocol creating a yield-bearing synthetic dollar backed by US Treasuries and DePIN infrastructure loans. They're building a new financial rail specially designed to fund and scale the physical infrastructure behind AI, compute, and decentralized connectivity. Conor, thanks so much for joining the podcast. It's so exciting to have you here because we're going to be talking about something that actually we and the Hotspotty team, we've been talking and thinking about this for quite some time, but then this TradFi world is a little bit over our heads and we decided to, move on to like more the tech side, which actually we understand. Well, thanks so much for joining. Let's start by you introducing yourself, your background, and what led you to go from TradFi into Web3 and DePIN.
Yeah, thanks so much for having me. So my background is in traditional finance. So started out my career working in investment banking, and then was working in private equity. And I had a lot of experience in kind of the structured credit space. So at the private equity fund I was working at in 2020, there was a really popular trade to basically roll up single family homes and then take them into the ABS market. And going through that process, we started to realize that there were maybe some interesting corollaries that you could participate in DeFi capital markets and take similar inspirations from traditional capital markets and apply it to DeFi. And so in 2021, we started this company. David and I are the co-founders. Both of our backgrounds were in finance. And I think what we were really interested in at the time was we were seeing kind of these 0 to 1 innovations with what I would consider to be money market category of transactions. So Uniswap, Aave, Compound. These were really innovations to allow you to trade liquid tokens or borrow against liquid tokens, which most closely resemble stocks and currencies, right, in the traditional world. And what we thought was interesting was if you could take some of the innovations of DeFi and apply them to the illiquid asset space, so debt capital markets, and infrastructure and asset financing. And in the last 3 or 4 years, we've done about $400 million of loan volume, but we've always struggled to kind of find the right collateral pair for our protocol. So what we're doing is at its core is structured credit. We're originating loans and then rolling them up into a single yield-bearing token. And you could think of that yield-bearing token almost as like a high-yield bond index. But the challenge is historically the collateral that's existed on chain has not really been high-quality collateral. And so if you think about the space that we're operating in, you have kind of the RWA space. And historically, the RWA space has really struggled to bring collateral that's quality on chain. And so what I mean by that is if you think about folks that are doing real estate tokenization, for example, or accessing small business lines of credit internationally, those markets are fairly well established. And so if you're bringing real estate into crypto, probably there's a reason why you're bringing it into crypto, which is that you couldn't access this traditional debt market. And that typically means that there's something wrong with the collateral. And so RWA protocols historically have just struggled with adverse selection where there wasn't a good reason why you were bringing that collateral on chain. The other category that would have maybe fit into, this use case would be traditional NFTs being art and collectible PFPs, which again, so in this case, less the argument of adverse selection, but more just that the collateral itself is not of high quality. And so there's no cash flows associated, highly speculative, and so on. So in the last year, what we've really come to realize is some of the most compelling kind of tokenizable collateral types are the assets that are underpinning DePIN networks. And the reason for that is twofold. So first of all, if you think about any infrastructure, traditionally you would finance that with debt because it's a high CapEx cost of business. And you typically would pair that with debt. You wouldn't finance that with, venture money, let's say. The other consideration is that these assets, as soon as you're earning cash flows on chain, you actually limit what you could do off chain in terms of financing. A bank is unlikely to give you a loan to stand up validators, right? Or stand up compute if it's earning tokens on chain. And so this is kind of a perfect combination for us to sit in, because it means that one, these are actually cash flowing collateral that's worthy of being financed. And two, it's facing challenges where it can't actually access traditional financial markets. And so this is a space that we think is really the right space for us to play in. And eventually, I do believe that you will have all manner of RWAs that get tokenized that don't have that adverse selection, but it's a slow process to get there. So that was really where we started to focus in on these DePIN networks, particularly compute, telecom, and energy assets, all three of which are high quality cash flowing asset types that can't access this traditional financing. And so in the DePIN space, you will have a governance token or a utility token that's being emitted to pay to attract these hardware operators to the network, which is extremely expensive, and ultimately typically results in the DePIN network's value collapsing over time because they're paying out so much in the form of emissions. If instead those hardware operators could finance their purchases of the hardware, they'd have less of a reason to demand such high yields, which should in turn drive more sustainable tokenomics for DePIN networks. And so that was kind of where we felt we could fit in most naturally. And ultimately, you get to benefit both sides of the equation, because on the borrower side, now I can access financing, which means I can expand my operations and operate as sort of a crypto native hardware operator. But then on the depositor side, you get to pass through yields that are higher than anything else you could get in crypto, and they're uncorrelated to the price of crypto. So, every other yield product you'll see is typically some kind of proxy to, Bitcoin or Ethereum or Solana's price movement. And that means that when prices are up, your yields are good, prices are down, yields are bad. That's not really an ideal, depositor experience for someone who's just seeking dollar on dollar yields. And so that was kind of where we felt we fit in really naturally, and was sort of the driving force behind rolling out USD.AI, which is now sort of the synthetic dollar product that you can access these yields and proliferate throughout the rest of DeFi.
Nice, thanks. That was a very good intro to the podcast for sure. So let's go back a little bit. So you guys started something called Meta Street, which is was the first trying to focus on NFTs to back for the lendings, right? And then you realized that maybe that's not the best one because the NFTs are not the most reliable assets, I guess. And then when was the magic moment that you guys realized, okay, maybe DePIN is the narrative that actually you can build what you're trying to do with NFTs before? And what kind of DePIN projects they mainly focus on? Because there are hundreds of different kinds of DePINs. I think some are more reliable than others for what you guys are trying to do with USD.AI. How that came to be?
There was no magic moment, honestly. It was trial and error. The reason I know about adverse selection problems or NFTs having poor attributes for collateral is we tried both of those things. And when we came to DePIN, what we realized was, so you mentioned MetaStreet was NFT lending, and that protocol layer is still the same structure that we're using today. What we realized, or the aha moment, I guess, was all of the DePIN networks ultimately are going to represent the assets with NFTs as well. And what we've seen in particular is, so you had kind of the 2021 helium days, right? Where you're selling an actual node to an end consumer, and that consumer is trying to participate in the network. Candidly, having individual consumers operating pieces of hardware is not an efficient design. And so you actually really want to have centralized operations with decentralized economic ownership. And that's where you get the benefit of scaling, because you can sell these individual nodes, the representation of that to an individual party, but the operations remain centralized. And the reason that's important is because if you have, a bunch of people that just have nodes sitting in their basement, you're going to end up offering low fidelity, solutions, and it's not going to be much of a value prop. And again, goes back to then token price collapses. And so when we think about the collateral that is most attractive to us, it's typically things that are higher cost at an individual basis, because again, makes more sense to finance those, and also will most likely drive the most value to the network itself. As you lower that fidelity by offering lower cost, nodes or whatever, the value prop to the network is ultimately going to be, a bit lower. And so that was kind of where we focused. That's why GPUs, as an example, is a really strong value prop, because high cash flows, very expensive assets, and typically co-located in a third-party data center.
Can you explain, like, very lame, simple terms, how does infrastructure loan work, and how would you, analyze, okay, this project, what is it, like, their credit worthiness, or how what's the very, very simple process to analyze those projects?
Yeah, so the loans are all happening on chain, but in order to get that loan on chain, you first have to represent the asset. And so that representation process is where we mint NFTs that represent these underlying nodes. Either we do or the DePIN network does. A lot of them are now also, just doing this themselves, first party. And so when we do that, we transfer the ownership from this, equity position into the separate entity, which is Permian Labs. That's our Delaware C Corp. And then we issue a bailment contract, not to get, too technical here, but we issue a bailment contract to the operator, who can then operate and profit from those machines. And in that process, we're also able to get a master insurance policy over these assets. So I think going back to the RWA point we made earlier, one of the biggest questions for anything that's interacting with the real world is, yes, you have this on-chain representation, but what is this actually going to map to? If there's a default, we need to repossess assets or hardware, what is that actually going to look like? And so that initial process of selling the asset out of this owner's hands into Permian Labs and getting the master insurance policy protects you from a scenario where somebody decides to sell their node on eBay or something, right? And then you end up not having collateral that's backing what's represented on chain. And so we basically developed a framework called Caliber, which allows us to tokenize assets, get insurance policy over that tokenized asset, and then have a true, value representation on chain that's actually backed by an insurance claim. So the underwriting process is sort of modular. So for each of these categories, there's different pools on the protocol that support these categories. And those pools have vault managers. And the vault managers actually they're not necessarily crypto native, although they may be. They're more just experts in that underlying collateral type. And so that vault manager will take a first loss position for all of the loans that are originated out of that pool. And so you get some alignment of incentives because they're putting up capital. They get outsized returns for doing that. But then if there's defaults because they were bad underwriters, they would bear the brunt of that loss. And that's kind of how we take that approach. I think it would be foolish for us to believe that we can be experts in every one of these categories and do a good job. And so we just don't take that responsibility at all.
I see. So like those vault managers are the ones who are going to kind of take the responsibility in case one of their assets the person goes and sell the device on eBay, like you mentioned. So there's like some levels of securities, I guess.
Yeah, the way we think about everything is levels of defense, right? So there's an equity cushion. The borrower has to put up, 30, 40% of the capital to buy, and then the loans amortize over time. So every 30 days, they're paying down some amount of their principal. These are depreciating assets, right? And so if you pay down this loan amount by a little bit each month, you're de-risking the debt position at all times.
How did you guys think about also on the, let's say, the DePIN projects or crypto projects in general? They're very susceptible about like, the bear market, bull market, so that the token price changes a lot. The ROI on those projects change as well a lot. For example, Helium, right? Like you were saying before, on 2021, the ROI for a buying device was days, and now it's like 10 years basically. So basically leaving this Helium IoT out of the game, like nobody really cares about Helium IoT in terms of when we're actually trying to make some passive income from that. How would you guys go about that, such a fluctuation of like a token prices?
Yeah, and I think this will normalize over time. So we don't think about token incentives at all when we're underwriting from the debt position. The only thing we're thinking about is what the steady state dollar economics are for these assets. So with GPUs, I'll just keep using this as an example because it's a fairly large category. So with GPUs, with an H100, if you're making market rental rate on H100 is about $2 an hour. And depending on your energy cost, that's somewhere between 30 and 40% ROI. And so if you have a 15% cost of capital on the debt side, you should be able to comfortably cover that debt cost. And that's basically accretive financing. It means that, you're not borrowing at 15 and making 10, right? Which would make no sense. So you can take the token incentives out altogether and just think about, if I was using these GPUs to rent, off chain, what would my economics be? It doesn't really matter what the token incentives are. And my expectation is that as you have a debt market that gets more, sophisticated and mature, that's backing these assets, you also won't need to give so many incentives as a DePIN network. And so you will end up with a much more kind of stable looking cash flow, which ultimately means that the DePIN network will be much healthier because they won't need to give away all these emissions and then have these like crazy drops in token value. And then they can focus more on aggregating the demand side, which they'll be able to do because they have a more permanent hardware base that is staying and sticky. And then so long as they can source the demand side, they end up with a profitable business as well.
Yeah, no, that makes a lot of sense. How do you, let's rephrase. What are the main components in terms of people that would be involved in this project? You have like the vault managers, you have the deployers who are actually going to put like 30, 40% collateral then to take the loans and to buy those devices or GPUs and deploy them. How can a normal person also join the project? I can just buy some USD.AI tokens, and then that's going to have like an APR yield for me. What are the main components and people that can be involved in this project?
Yeah, let's go just straight down the value stack. So you have at the furthest consumer facing side, the DePIN network. They're going to be, creating the value for the collateral in the first place because they're sourcing the demand side. And that implicitly provides value to the hardware operator. Now, the hardware operator will typically, the operations will either be, I think in steady state, will either be done by the DePIN network or by sophisticated operators who do not want to have a capital intensive business. And so that operator will take a fee, whether that's the DePIN network or, some third party that's doing that. And then you have the economic interest. So let's say that you want to participate in, the AI revolution and you want to buy GPUs, but you don't want to have to be signing data center contracts and so on. You'll just buy an NFT. And that NFT will represent the cash flows coming from these GPUs. And then you can post that NFT as collateral with us to borrow the debt amount. So that's your first spot, right? Let's say you're buying a, $300,000 server of H100s, and you would only have to put down $50,000, let's say. And then you'd be able to borrow $250,000 and you can participate at that level. That participant does not need to be an operator or have expertise really to do so. And that's the progression of 375 AI, Silicon.net. There are projects that are doing this already. And then you have the vault managers who are, once again, these are more sophisticated, private credit fund types, not going to be individuals. And they're going to, be providing the, sourcing the underwriting and origination of these deals. And then you have USD.AI, which is ultimately the debt position. So let's say that you want, exposure to DePIN as an asset class, but you don't want to be in the equity position where you might be taking on lots of risk, having to underwrite specific DePIN network economics and so on. You can just buy USD.AI, and all you're participating in is this lower risk debt position across not just compute, right, but also telecom, energy, and within those categories, the various projects that are, focus on that category.
So you'd be targeting around 15-25% APR, right, on the USD.AI. So the easiest thing that I could do right now, or like not, but in soon in the future, is that I just need to acquire those tokens, and that would automatically yield those returns. And with that, I'll be helping other DePIN projects and DePIN ecosystem overall, right?
Yep. And I wanted to also touch on something you mentioned earlier on the rewards and the collapse of the rewards, on these DePIN networks and what that all looks like. So if you look at the non-crypto hardware financing business, the yields are typically 15 to 20%. And that is, at large scale. So CoreWeave, which is, basically the largest neocloud of compute, did a $7 billion loan of Blackstone before they IPO'd, when they were in their earlier days. And that cost of capital was SOFR plus 11. So it's basically a 16% yield. And that was Blackstone's largest private credit deal ever. And that shows you that, at tremendous size, this is still kind of the cost of capital for this stuff. And one of the things that's really interesting is if you think about the neocloud space and how that's kind of popped up in the last 2 or 3 years, where you've got folks that are raising, $100 million, $200 million funding rounds. And you might wonder, like, what are they using that money for? Because typically, if you're raising venture money, you're building, software, high growth activities. Neoclouds are using that money literally to buy machines. So it is a terrible use of capital. You're raising venture money, which is the most expensive financing you can get, to buy machines that depreciate, right? It makes no sense. But the reason that's happening is because it's just a new industry and people aren't, aware that you can actually finance this stuff. Or if they're getting financing terms from traditional lenders, they're really onerous. They have a bunch of recourse into the business, and it just is, unpalatable for startups to participate in.
Yeah, no, that's exactly. I think I've talked to a bunch of people in the past about that. Like you cannot or shouldn't take VC money to buy hardware, right? It's a crazy concept, but like you mentioned, there's a lot of people who are doing it because they wasn't sure how to do it. They're very new to the space, etc. A lot of people come, I guess, from more technical background and then just deploy the way they think it's the most correct way to do it, right? So the project also secured backing from was it Binance Incubation, Arbitrum, Dragonfly, among others. What did resonate most with the investors about the vision of this project?
Investors are looking for, a large TAM and teams that can actually execute that vision. And I think what's unique for us is our background really aligns nicely for this. The third co-founder, Ivan, our CTO, he was at DRW, but before that, he was working at 21.co. So he was literally at the first, at scale Bitcoin miner and saw all of the challenges that industry faced. And we obviously have, a lot of finance background on our team. So we kind of understand how to structure these types of products. And then the TAM is monstrous. I mean, to put it in comparison, like, again, with that CoreWeave deal, CoreWeave, a single company, did $7 billion in secured financing against GPUs. And by comparison, Athena, by and large, the most successful latest DeFi project that's come out of the last couple of years, at its peak TVL for the basis trade was $7 billion. So the size of this market is so much bigger than everything that people think about in crypto. And there's no reason why you couldn't take share in this market, in particular, because what I think crypto is better at than anything else is capital formation. And so if you're able to attract capital to this yield-bearing synthetic dollar, and you can do that at scale, there's no reason why USD.AI as a financing vehicle couldn't compete with every other, private credit or bank loan provider for secured financing with these assets. And it's just going to get bigger, right? And one of the things we think about in the AI space is a lot of people will talk about, the rental rates on H100s and how maybe that's come down relative to what people were paying to train models. And when you think about this, if this turned out to be true, that inference for GPUs yielded a lower return than training, the whole industry doesn't work. Because if you're the AI startup that's paying for training, the training cost is their input cost, right? That's the upfront capital that they're putting up. The inference returns have to be, far in excess of the cost to train, or else the whole business model doesn't make sense. And of course, that will turn out to be the case. I think you saw with ChatGPT, with the giblification of everything a few weeks ago, image rendering is a far more compute-intensive activity than text inference. And it's also barely begun to, be explored because the models are just now getting to the point where they're good enough to do stuff like that. And then you think, okay, image rendering will be an order of magnitude more volume on the demand side than text inference. But video rendering will be even more order of magnitude larger. And think about everything you interact with today is video and image. Very, very little, text-based interaction throughout like digital interfaces. And so we really think that the size of the market is very large and also very untapped. And I think that's what investors are really looking for when they're investing in projects like this.
No, I get very excited about this because I believe this can be like kind of the backbone of a lot of DePINs, right? Like especially the ones that are like very expensive and they're going to actually go for a massive share of the industry. And something that we've always been like working towards, like a DePIN can really take over these markets. But sometimes what is missing is that part of like financing because they're very expensive hardware. It takes like, I think projects, I don't know, like World Mobile where they have like $100,000 antennas that it's very hard for one entity to actually deploy those devices because first you have deployment, of course the financing, I think is the most difficult thing.
Yeah, you want a fully crypto native value proposition, right? And Jensen or Ambient, like these new AI oriented blockchain products, the users of those products will want to access on-chain financing because they're operating on-chain. And so you need both sides of the equation, but having something that's fully start to finish an on-chain experience is just a superior user experience to having to explain what decentralized compute means to a bank and justify why you're making your money that way versus dealing with someone who is already kind of comfortable with what that looks like.
Yeah, no, absolutely. What have you guys already built and what's in the pipe for the next, let's say 3 years, for example?
Everything that we've been building has kind of built on top of previous iterations. And so the whole structure of borrowing against NFTs, we use a peer-to-pool design, and the pools have tranches of capital within them. All of that was built to solve these kind of low liquidity problems. And whether you're lending to RWAs, Ardent collectibles, or GPUs, it actually doesn't really matter. It's the same form factor for all three. And so over the last 3 years, we've sort of iterated on that design constantly to get to a point now where if I was just starting this today, I'm not sure that I would, be able to quickly execute and deliver a product that is usable to the market, because we've literally been doing this for 3 years now, kind of iterating on this design. My expectation is that, once USD.AI goes live, all of the growth from here will look more like a 1 to 100 as opposed to a 0 to 1. And so that means, proliferating the USD.AI synthetic dollar throughout DeFi ecosystems, onboarding more vault managers and attracting more borrowers. And so this will look hopefully more just like a traditional scaling process from there. Now that the infrastructure has been built, and really this is the beauty of smart contract based products, there's no marginal cost to add an extra zero to your TVL, right? But obviously there's a lot of economic returns for doing so. And we expect we would have probably the same size team. We have about 18 people right now. I don't see any reason why we need to even grow our team or anything. Uniswap, for all of Uniswap's success, really that all occurred with a team of less than 20 people. And all of the, growth they've seen in their headcount and so on since then has almost been unnecessary versus kind of the core product that they're offering. And that's really, that's what the beauty of smart contracts are, right?
What was the biggest challenge you guys faced up to now? And how do you think the next challenges are going to be?
I mean, just finding the right collateral has always been the challenge. And it's because none of this stuff is natively on chain today. It's not clean. And so, landing on this category, it's taken us literally 3 years to figure that out. And maybe 3 years for the market to kind of like also be there for us to match what we're doing. And I think the challenge going forward will be, as we scale capital that's participating in this, is just making sure that processes are, ironclad and we know everything that could possibly happen and what the steps will be to prevent, problems when that happens. For example, there will be defaults. Like I'm certain of that. And so having the right process, the way that it works for us is the default auctions occur on chain, right? And so you have to have buyers that are ready to buy those assets. And so making sure that as the debt, scales up and the capital book scales up, that all of the processes still work when you're going from, $100 million of deposits to $1 billion, and you start to, get into larger and larger scale. Just making sure things don't break, right? And we want to make things as anti-fragile as possible. And I think that's the design we've created, but you never know until it's all out there in the open.
You got to test it in real life, see what happens. Because it was in 2023, 2022, there was this project called Polymobile. They were trying to build this decentralized, kind of like Helium Mobile right now in the cell phone plans. But it was an amazing time because you can see the project's moving super fast. I remember I had a SIM card that I could actually use when I was in LA testing. And then the project just did a lot of wrong decisions and they had to shut down. And letting a lot of people had invested hundreds of thousands of dollars in the mud, basically.
And that is why I'm more comfortable dealing with asset-backed financing than I am extending loans to businesses, right? You don't have to have you don't have counterparty risk when your counterparty is a H100 in a data center, right? There's a market price for that. There's a market price for the commodity that it spits out, and your counterparty risk is walled off by this insurance coverage. And so I'm much more comfortable dealing with those asset types. Now, it's possible that, machines will depreciate faster than what the loan durations are, and that you might have, loss in value from that. But that's something that you can underwrite and understand. What I would not want to do is be extending, business loans to counterparties for them to finance their operations. Right. There's, again, it goes back to the adverse selection problem. There's a whole market for that. Right. And that's a very tried and tested market. And we're not well equipped to support that stuff. But asset financing, it's a lot easier to understand and you have a lot less counterparty risk.
Any final thoughts that you'd like to tell the community? We have, hundreds of thousands of people in our newsletter that are going to be listening to this podcast to know what's happening, what's exciting about. How can people know more about the project? And what would you like them to know about you?
Yeah, so USD.AI is the domain name, so easy to remember. You can go there to learn more about the project. The last thing I wanted to cover is the actual redemption mechanism for users who are depositing dollars into USD.AI and how they get those dollars back. Because having, collateral that's fairly valued and above the debt amount is not enough, right? So you need, if there's no redemption mechanism, then things trade off because people are just discounting that illiquidity. And so the way we've kind of solved this is, these loans are amortizing. So that means every 30 days, you get a portion of the principal of the loan back. And that portion of the principal is what users can redeem and get dollars back from their USD.AI holdings. And so the way that we call this Q extractable value, but basically this is a market process as opposed to having sort of a first in, first out redemption queue. So imagine, you deposited $10,000 and someone else deposited $5 million. And that 5 million depositor decides, I actually want to redeem my position. If you have a traditional kind of first in, first out queue, that 10K guy is going to take a while for him to get his money back, right? Because there's this huge order ahead of him. And so that jams up the queue. And then you have uncertainty about your redemption. And then what happens? Token trades off. And so instead of having it designed that way, the design is an auction. So if you have $5 million and someone else has $10,000, both of you will be bidding based on how aggressively you want to enter into this next, amortization window and pull your money out. And that way you can just bid more. And if you're willing to pay a premium, you get out ahead of the other guy. And so instead of having sort of these like backlogged queues, you can use market pricing to determine what your position in the redemption is. Maybe you really need that money. And so you'll pay, 75 bips to get out. And the $5 million guy is only willing to pay 10 bips. Well, he's going to end up not getting all of his money out because you're going to get, your money out first. So I think that market dynamic is super important for any stablecoin, synthetic dollar type product where you have to be able to redeem out of your underlying. Otherwise, things won't trade at par. And that was kind of how we walled off that risk. So the way I would, my overarching comment on everything we're doing here is lines of defense. And at every stage, we're trying to add as many lines of defense as possible so that, nothing is riskless. Like this is not a treasury backed, T-bill backed product, right? Like there are risks here, but at every level we've added, lines of defense to try to mitigate as much risk as possible. And that's why I think for a 15 to 20% yield, that's a pretty good risk adjusted, return profile. And I think people will like a product like that, especially because you're uncorrelated to the rest of crypto. But yeah, that's been a great conversation. And yeah, USD.AI, people can check it out and learn more.
When can people actually start depositing their money and start getting some of that sweet deal?
Early May is my expectation. We're in audit right now on testnet. So barring any unforeseen circumstances, I think probably an early May launch.
That's pretty cool. It's pretty soon.
Yeah.
Are you guys going to be like in Token 2049 celebrating that?
We will be at Token 2049, yes.
Awesome. And so looking forward to see you in person there as well. I've been talking to some people from your team and let's build. I think that's something that's very missing on the DePIN ecosystem right now. It can really help it scale even more. So it just was, a pleasure to talk to you on the podcast and hope to see you in person as well so we can cheer over your guys' work.
Thanks, Daniel. Thanks for the time.
Thanks, man.